Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Commercial Agent Success Strategies. You want to check this out. If you're in commercial real estate brokerage, this will be the best training you've ever seen in your life, and I guarantee it. I created it, so I must like it, right? Check it out. Visit commercialagentsuccess.com. Well, today we have a treat for you. We're going to have John D'Angelo on the show. He's Real Estate Solutions Leader for Deloitte, and they just came out with the report, the 2024 Commercial Real Estate Outlook, and the theme is Finding Terra Firma. Please welcome John to the show. John, thanks for coming, and good to see you.
Good to see you too, Michael. Thanks for having me.
And for those of you watching the video version, there's some cool cars behind John, so you get a little more of a treat than just looking at the two of us. So John, tell us a little bit about this report, this survey, how you guys do it, and how many people are involved.
Yeah, so Michael, we surveyed 750 CFOs from really around the world. So a lot of them from North America, but also Asia Pac and Europe represented. And asked the respondents a number of questions, sort of thinking about their business, their outlook, the things that they're worried about. In particular, we talked to people about how they're using technology and what they're thinking about related to technology, and have been doing it for the last several years. So, we're starting to get a decent amount of time slice data to look back on, but had good participation, and we'll talk about it. I think a couple of surprises and a couple of things, or several things that weren't particularly surprising, given that this was done kind of early summer this year. So I think the survey went out in June. So a lot of things that are true today were true, 3-4 months ago.
Yeah, that's interesting. So what is the general outlook of participants, and how has that adjusted over the last year?
I find, after having worked in real estate for 30-something years now, that generally the people that lead real estate companies are an optimistic bunch, but that wasn't the case this year. I think we said it in the report. It was the most pessimistic in terms of revenue outlook. We asked people about their thoughts on revenue for the next 12 to 15 months, and we got the most pessimistic response back than we've ever had in the survey group. So, 60% were expecting declining revenue for the year ahead, compared to, the same question last year. It was about 45% that expected revenue, down year over year in the coming year. So, a bit of a pessimistic group this year.
Yeah. Well, I guess it's understandable with the rapid rate of increases we've had from the Fed on interest rates, and how that's really adjusting values and the economy. What were the plans? What's different about what the CFOs plan to do regarding this slowdown? Are they adjusting their spending? Are they adjusting obviously they're adjusting their transaction volume.
Yeah, so 40% of people responding said they were expecting to cut expenses in the year ahead, and that's up. The last 2 years, 6% were looking to cut expenses. This time it was 40%. So sort of makes sense that those hang together. And interestingly, of a real estate group surveyed, a bunch of those said that they expected to find the expense cuts in reduced office space. I was kind of surprised about that. And the other piece was, in talent-related actions.
So the two worst places to cut, I would think, in your office space, where you get people together to get things done, and then in your people. It seems like the two places you want to spend. How about spending on technology?
Yeah, listen, the number of people saying that they were going to increase technology sort of plummeted. So, we're seeing sort of either flat to decrease in technology. But, I think we didn't see as much drop in technology spend. I think partly because the industry still has catch up to do. And as somebody who has served the real estate industry for a long time in technology and transformation related initiatives, we are seeing projects that just aren't, they're not optional. So you might expect that that would be a place that people would find cuts, and that didn't get reflected. So, and it's, I think, largely because, Michael, people don't have a choice. They have to continue to catch up in what we call, tech related debt or technology debt. They're having to repay.
So they expect to slow down. They're slowing down spending. What are they doing about acquisitions? Are some folks looking at this as an opportunity, or the longer pause? What are they expecting on timing?
As we're, I think we continue to sort of see some uncertainty about, when interest rates are going to stabilize. And the cost of debt has gone up so much, and liquidity, so availability of debt has gone down. Still some pessimism about transactions. And listen, I was at a conference, I don't know, 2, 3 weeks ago, with global investors, and the one panel discussion was that there's going to be, some deals for, sort of brave capital, the likes of which we haven't seen in a long time. Just as people are cautious about transactions, but the consensus view was, we're likely to see a period of great opportunity for those that either don't need leverage, or have alternate sources of capital.
Yeah, we're certainly seeing that on the ground as brokers, especially in the land market, where some investors are able to buy land where they just couldn't compete for it before, right? Um,
Yeah.
it's amazing. We got a parking lot downtown Atlanta that shoots off a real nice income, and it would have sold for so much with the apartment developers bidding it up that somebody buying it for income and future long-term hold couldn't compete. Well, now they can. They're like, okay, this is great. I can get a good income property with a long-term hold.
Where fundamentals are great, right?
Yeah, yeah, and
Yeah.
where to your point, where properties that may not have been available before, and we're seeing a lot of that too on some of the mid tier properties and smaller properties where investors are buying for their own companies for their own use. Right, it's a good time for users.
Well, and it's interesting is I think sort of seller expectations are catching up to market realities. It's just sort of helping with transactions happening again.
Yeah, and what about the property types? Did you see anything interesting in your survey related to allocation or thoughts on any particular sector?
Maybe this is not surprising, but we asked CFOs where they thought the greatest risk-adjusted return potential was, and the one that shot up to the top is digital real estate. So,
Hmm.
to think cell towers and data centers, with a bunch of demand drivers still behind them. The other one that sort of shot up to the top is single family rentals or single family for rent. And it seems like some of that is driven by people getting priced out of the housing market, that want to have a house. And SFR being a way to get into a house without dealing with having a big sort of personal balance sheet. So those kind of shot up to the top of the list. And maybe not surprisingly, both suburban and urban office dropped on the list. I think we had urban, so CBD office is the number one opportunity last year, and it's just people continue to be pessimistic about it.
And was there anything in the survey or responses about the timing for office demand and when people expect it to come back some?
We didn't really ask about timing. So I'm sort of looking at sort of consensus views that hopefully we return to some sort of normal in 24 under the finding terra firma heading. As kind of seller expectations have changed. There is a bunch in occupiers, certainly office occupiers, getting to a place where they feel like they've got a line of sight into, what their space needs are going to be. There was just so much uncertainty as we've, kind of gone through remote and hybrid, the great resignation, in figuring out, how people occupy space and how, hybrid work arrangements relate to keeping a workforce together. It seems like we're getting to a place where that's stabilizing. Um, so I think there's a little bit more understanding about what the office space footprint looks like, particularly by big occupiers. So it seems like that's boosting confidence.
Yeah, I agree. The bigger occupiers are going to move the needle, and that seems to be the biggest challenge for the big occupiers to get their folks back because, yeah, and then I see the smaller occupiers almost never left. They're still in the office, and when you talk about hybrid, it's kind of interesting because it sounds like uh, the CFOs of the real estate companies say, well, we're going to use less office space, uh, but they're expecting other folks might be coming back more than them. Like,
Yeah, well, I guess the way you square that circle is we surveyed across all property types. So
right.
I imagine it's a slightly different answer from our office owner operator developer client base.
I was with a developer, owner operator of a lot of office buildings a few weeks ago, and we're at a networking event, and he said, "Excuse me, I got to get out of this conversation. I got to go work on a 1,200 or 1,800 square foot office lease." He said, "I'd have never been even involved in it before, but now I'm all over it." Right?
Right. Yeah, exactly. The amount of attention is probably a little bit outsized in today's market.
So this is a great report, and it's nice that you guys do this survey and put this out here. And and anybody that likes to see it, we'll have a link at CREshow.com on the current show. And if you just Google search Deloitte CRE Outlook 2024, you can find a link to it. And John, as you look at this survey and your report on it, and you look at past surveys, what else kind of jumps out to you as potential maybe challenges or opportunities?
I guess thinking about two things, Michael. One is, well, actually, there's three things that I want to point out. One is, I was surprised this year so we asked people, what risk they're most worried about that would affect financial performance of their enterprise. And the one that shot up to the top of the list was cyber risk. So it's just interesting that that is top of mind for a bunch of companies. And I think the explanation is, sort of as smarter technologies go down to the building level, there's just more vulnerabilities. And, cyber threats are becoming a lot more sophisticated. But still, I was surprised that that was so much on the top of people's minds. The other, I guess, the second of the three things is, we've asked over the last several years how people feel about their basic technology footprint, from kind of antiquated server in the basement, on premises, to fully modernized in the cloud, kind of ready to absorb new technologies. And we have seen this steady shift, as you would expect, from kind of antiquated to more modernized. But last year, at one end of the spectrum, the number of respondents who said, "Yeah, we are there. We are fully modernized. We are ready for anything," was 15%. This year, it went down to 5%. And I think the explanation is people are realizing the goalposts keep moving. So, what fully modernized and ready for anything meant a year ago is different than it means today. So actually, I think that's reasonably healthy. And then the last thing that was, I guess, still a little bit of a surprise to me is we asked about readiness for for ESG reporting. Um, and still the number of people that are saying, look, we're not ready, is like 60% of our respondents have said we don't have the data, it's not captured in systems, I don't trust it. And I expect that number is going to go up, as the demands for sustainability reporting continue to go up.
Yeah, yeah, it makes sense. And when going back to the cyber risk, it seems like even gets tougher when you have hybrid. You have people working from anywhere, right?
Yeah, there's just so many different points of vulnerability. It's just it's a different, more complicated environment than it was, even a couple of years ago. Um, and the bad guys have gotten smarter.
And the real estate owners are concerned, about their real estate and the vulnerability of all the online pieces of those properties. But yeah, I'm wondering also if some of the companies trying to get their folks back in the office, if trade secrets and cybersecurity becomes an issue there, where it's just really more difficult all the time to protect everything when people are just all over the world.
Yeah, no, I think that's partly the case. The other thing that is, and boy, Michael, if you don't know what to talk about in my line of work, talk about generative AI. It seems to be the topic everybody wants to talk about for lots of good reasons, because it's sort of gotten to the board level, and into the C-suite. But it brings up data vulnerabilities. As you've got people that are experimenting with it, sort of exposing enterprise data to these tools, and they just don't understand the risks. So, I get that the playing field has changed a bit.
Yeah. What about opportunities? When you look at this report and then your experience in industry and kind of where we are, where are there some opportunities potentially?
Yeah, it's a really good question, Michael. Listen, I think back to what our clients told us, that the digital real estate and kind of needs-based real estate, long-term care, senior housing, industrial, continue to have great demand drivers behind them, and it'll be interesting to see, as the construction for industrial, we're kind of getting through a big increase in construction that's getting delivered now. But still, as manufacturing is, there's lots of reasons for manufacturing to come back onshore, and companies have rebuilt supply chains for resiliency. We still see great demand drivers for industrial. Now, the big question for opportunities is, where do you spot opportunities where others don't see them? And you sort of got me about that, except we've had interesting conversations with companies that are looking for, how do we really, look for adaptive reuse opportunities? Is kind of functionally obsolete, kind of class B and lower, not well located office buildings need to become something else. I think investors are asking some pretty smart questions about, what can we do to do something about that opportunity? How do we sort of set ourselves up, and look for ways to accelerate that, or really focus in on it.
Great.
So sort of see some potential green shoots there.
Yeah, a good point. And what about opportunistic investors, groups? Did they expect to see more opportunities, and more maybe than the last recession or less?
I think it gets back to looking for some stability in the cost of debt and availability of debt. And sellers either not being able to hang on any longer, or really getting a reset on expectations of value. As we were talking about, there's just the transaction volumes have gone down so much, that there aren't great comps. So sort of figuring out where the market is, and has it reached bottom? is still it's still a big challenge.
Yeah, it is. And if you remember though, back in the Great Recession, we've heard that for, I don't know, it seems like I heard that for 3 years or so, 4 years. We're at the bottom. I don't want to catch a falling knife, but those investors did extremely well. We don't have to get at the very
Right.
bottom of a market, right, to do well.
Exactly.
Yeah.
Yeah, and that's where I think the term brave capital is really it's a good term. We'll start to see sort of people move into the market, and then it's such a flocking industry. But the first movers, I think, in this market are going to have like in so many markets, but in this market in particular, are going to have a great opportunity for some bargains.
What's your sense of liquidity in the market or from your respondents?
It's not great. It is right up at the top of things that people point to for sort of headwinds or challenges. That there's just still isn't. The GSIBs are still sort of struggling with a lot of real estate on the balance sheet that normally would have been recycled, but not wanting to get it off their books at a loss. Um, so the big banks are still, not lending at nearly the rates that they were. So I think we'll see, kind of private debt come back, and sort of candidly, sort of seeing people looking for opportunities there. But it's still a challenge. It's not reset to normal.
Yeah, well, it's interesting because it seems like for lenders, it's a wonderful opportunity to do loans and build relationships that are probably some of the safest loans that they've done in a long time. At least you won't have maturity risk, right? Well, rate risk at maturity. Well, we hope not, right?
Right.
Less
Yeah.
competition, probably better assets and borrowers. We just had a lender reach out today that I'm real familiar with, and they've really beefed up their team, and they're really looking at this as an opportunity. But I guess they don't have some of the challenges some of the other banks have.
Boy, and there's just so much dry powder on the sidelines, Michael. You got to believe that. Listen, if I had a crystal ball, I'd probably be doing something else. But you got to believe that's all. That all adds up to a change in transaction volumes. Hopefully in the first half of 24.
Yeah. Well, another green shoot as far as us in the southeast at our shop, we're starting to see things pick up a little bit, and maybe that's the optimistic broker in me that's grabbing on that green shoot. But we're starting to see some sellers come around with some great properties at 9 caps, and it reminds me of it. Remember back in the day, John, when 10 caps were the normal?
Yeah, exactly. I mean, think about the people that are in our industry that have never heard of double-digit caps,
Right,
right?
right. Yeah. If you're not in your late 40s, you probably haven't been in a decision chair during a recession before, right?
No, exactly. People thinking the three, four caps were just normal. It's, kind of debt availability, kind of long-term rates of 3 or 4% was normal. It's not normal.
Yeah.
Um, and we're coming back to that.
Yeah. Well, John, what would you leave our audience with to think about with the report this year and the survey results?
Yeah, listen, I think there is something about the resiliency of real estate, Michael. That it goes through cycles. You got to believe that we're coming out of a cycle. The demand for various uses of real estate in so many ways is evergreen. So as we start to come from a tremendous amount of uncertainty, into sort of line of sight for opportunities, just encourage people to put their thinking caps on, um, and think about where there's opportunities, in advance of the headlines.
Yeah,
Um,
that's a good point. I was just with a family office this morning, and they're really excited about the I guess the lowered prices and getting a better basis now, and they look at real estate as a really long term hold.
yeah, yeah, exactly. Um, and I think that, to the extent that you can, to figure out where real estate fits into, an overall investment strategy, or, is your core business. You just got to believe that there's going to be some great acquisition opportunities as things are starting to stabilize. Um, so yeah, first movers tend to have a great advantage in markets like this.
Yeah. It reminds me, have a property that I've owned a very long time. I bought it, interest rates were really high. And so there wasn't that much demand. I showed it to the investors that I was working with. No, it's too expensive, and so I got it at a great basis, but it was a long-term hold. So it doesn't really matter what interest rates were at that time, except that maybe I got in at a lower price per foot.
Right, and I'm sure that whatever leverage you have has been reset a couple of times as
Yeah.
you've owned it.
Yeah, and
Yeah,
and now it's gone, right? So it doesn't really
right,
matter anymore, right? If you hold it long
yeah,
enough, and real estate's considered a long-term hold typically by most people, right?
right,
It's the guys that
yeah.
had the 2.5%, 3% money that were flipping in 2 or 3 years. It's like, all right, now what do we do?
Uh, Right, and people that were, people that got in the market in kind of whatever 2015 to 2020, it just seemed like, it was always going to go up.
Yeah,
And chances are they'd still be trading on gains,
yeah,
um,
that's true.
just depending on when they bought.
And one of the situations we see too with a lot of clients right now, even if they're coming around on pricing, but even if they don't like the current rental increases they're getting on their properties or the current value, they had a big run up on the rents, on the revenues, right? Like you look at some of
Yeah,
the apartments, they had 10% increases every year for like 3 more years. That's just,
like historic increases.
yeah.
Yeah,
So even if that, you adjust your cap rate up, you're winning.
right. And inevitably that was going to flatten out, and we're seeing rent price increases flatten out some, but good grief, they went they were on a tear for a few years, so at some point they just had to flatten out.
Yeah, and I think some of these clients and owners groups are understanding. Hey, if we're going to take a nice profit, we can't make decisions looking through the rearview mirror. Got to look through the windshield and make decisions based on. Hey, if we can make a profit, it's a profit. It doesn't have to be what we expected it to be, 3 years ago.
Right. It took, I think it took or is taking a little bit of time for that to settle
Yeah.
in. But it seems as though that's starting to sort of settle in, that this is that whatever you thought your property was worth a couple of years ago is not the case today.
Yeah, and it's always interesting too to me is that when we price a property, we give pricing guidance to a client. If they don't like it, they think about the future. Well, we don't really know what the future value is going to be. We know now, pretty much know now,
Right.
but we don't know in the future. So if you don't like it now, you might not like it later if you could take a profit and move on, right?
Right.
All right,
Exactly.
I'm through preaching to sellers, right? But that does seem to be one of the biggest challenges, right? Is for ownership groups, for sellers to understand that, hey, when you have this big a change in interest rates, it's a change in value. I gave an example the other day of just 100 basis points change in a cap rate on an $85 million deal. Went from a 5 cap to a 6 cap. This is a Class A incredible property, just beautiful. And but even that, just 1 percentage rate change on the cap adjusted the value by $15 million, right? So,
Yeah. It's a huge move. Right.
yeah, and you look at the properties that
Yeah.
might have 200 basis points change in the same price range. That might be 30 million. It's a big change, and it is hard to get your arms around as the owner.
Listen, I certainly get it, Michael. I get the psychology, but yeah, as people, either need to kind of adjust their portfolio or just need to get out. Just getting realistic, and now finally there are some comps that that sort of support that line of thinking. It's just that the volume is so low that getting people to right. We're still preaching to the sellers, to be
Well,
realistic about
yeah.
value is a thing.
Well, I'll preach to the buyers. I bought properties when interest rates were extremely high, and had negative leverage. I was paying more on my loan rate than my cap rate, and I did well, and I made money. And I think part of it was probably because the basis was lower, right? I'm not going
Yeah.
to pay that interest rate forever. And I did make money. And so you talk to some people now that have been in the business for 10 or 12 years, and they're like, what do you mean you had negative leverage? How could you pay a 6 cap and have 10% interest rate money and make money?
Yeah.
You
Well,
still can.
and some of that's just, by understanding the fundamentals, right? That the market today is not going to be the market forever.
Yeah. Well, great report, great survey. John, thanks for joining us again. Great information as usual. Thank you, sir.
No, my pleasure, Michael. It's always good to talk. Thanks for having me.
All right, and thank you around the country. That's John D'Angelo, Real Estate Solutions Leader with Deloitte, about their report 2024, Commercial Real Estate Outlook, Finding Terra Firma. And again, you can find this at CREshow.com or just Google Deloitte CRE Outlook 2024. Thanks for joining us around the country. Till next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bullitt Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. And by Lument. For senior housing, healthcare, and multifamily financing, visit lumet.com. For more podcasts and videos, subscribe and visit CREshow.com.